Advisors with a market and positioning update for the all asset strategy, active fixed income strategy, and systematic macro. Basically, we've had a transition from quad 2 to quad 3, which is risk off. Quad 3 is growth slowing, inflation reaccelerating. The setup we had coming into this was a risk matrix that leaned toward quad 2. The weather map, which we'll cover in a little bit, was indicating 2 months ago, saying that a probable regime change was on the horizon, unfavorable from quad 2. So we were kind of ready for that. And the bean counting of the economic data was saying that the second and third quarter, the most likely outcome was quad 3. Then we observed the risk matrix undergoing a phase transition. And when quad 3 took the lead, we made changes in each of the portfolios. None of this includes the impact of a wide range of government policies that are set to change. But if you look at the economic policy uncertainty index, it's near record high levels. The only time it was at these levels was in the middle of COVID and the financial crisis. And it's not just one policy, there's a handful of policies. Each has the potential to make a significant impact on the economy, and it could be positive or negative. It wouldn't be fair to look at everything and just say it's negative any more than it would be fair to look at everything and just assume it's going to be positive. It's going to be a mixed bag. So the sequence matters a lot. And we're looking for the next couple of quarters to be choppy, to say the least. Reviewing performance, all asset finished 2024 up 710 versus the index of 855. Of course, we would like to be ahead of the index, but given what we were seeing on the weather map, we kind of leaned toward taking less risk than the index. We're a little bit ahead year to date. If you look at the combined period, it's 826 versus 890. The beta is a measure of risk. So overall, we've captured about 93% of the index return, and we've taken about half of the risk. So we would like that relationship to be favorable. The active fixed income, or AFI, finished 2024 up 657. And by the way, these are a proxy. We use a proxy account for the performance. Everybody's actual performance is going to vary a little bit depending on whether money was taken out of the account, whether money was put into the account. So here we've selected proxy accounts that have no flows in or out. And of course, all the accounts are traded the same. Everyone gets the same price. Everyone gets the same allocation. We do that through block trading. So we'll go over your individual performance when we connect. But the proxy account is up 363 year to date. And over the combined period, 1044 versus 490. Most of that outperformance, you can see we matched on the upside this year, which has so far been good for bonds, mainly because the stock market's been having trouble. Last year was another bad year for bonds. And the fact that we're not just confined to owning bonds, we can own things like the US dollar index, gold. We can even, hedge bond exposure, which last year we had a hedge on that protected us from long rates going up. So most of that difference is due to, blocking the downside more than it's been, chasing the upside. So we got more than double the performance, and we took barely any risk to do it. Here is an update on where we stand in the economic cycle. This was the slide that we had last time. So you can see in the left-hand panel, the red line indicates -4 on the leading economy. Anytime historically that leading indicators have been -4 or worse, it's led to a recession. And in the second panel, you can see how we had an immediate decline in the cyclical economy, but then it flatlined. And for a couple of updates in a row, we sounded like a broken record saying it's still flatlining. But last time it did begin to show up with the cyclical economy getting pulled down. Here's the update. So we've had improvement in the leading indicators, but it's almost like it's too late for that to flow through to the cyclical economy. That decline has continued. The third panel over is the aggregate economy. That's what matters in terms of recession. So the aggregate economy is saying at the moment that a recession is nothing to worry about. And one of two things are going to happen. Either the leading indicators are going to get out of negative territory and go positive, in which case you could look at the cyclical economy and say we would expect that to rebound. If that rebounds, then the aggregate economy holds up. The other scenario would be that the leading economy remains negative. That continues to put downward pressure on the cyclical economy in the second panel. And then it's a matter of time before the aggregate economy starts to turn down. Here is the tool that we use to determine the current market regime. Don't worry if you can't read it. I had to squeeze it all onto one page, but we can spend time. If you click the Calendly link to set up a one-on-one, we can walk through this in more detail. But the thing to notice on here is the green column headings in the upper left are different global stock markets. And you see the top line doesn't match the bottom line. The bottom line would be the most current day. The red indicates measures of volatility, and you do notice change from the top line to the bottom line there. The dark blue is commodities, and they've been pretty consistent throughout. The lime green are foreign currencies, and you can see there's been change from the top line to the bottom line. And the yellow are global bond markets and credit spreads. And for the most part, the top lines show quite a bit of change to the bottom lines. That is a phase transition. And if you look at the bottom line and characterize that performance across all assets all over the globe, it's most consistent with Quad 3. The phase transition goes back further. It began further than what I'm just showing here, which is 227. Began about mid-February and was completed 3/3. Here is another tool that we use to indicate the probability of regime change. So if we go back to this one, this says, what regime are we currently in now? This says, what's the likelihood of regime change going forward? About 3 months ago, the stock market flipped to red, to unfavorable. So we were in a Quad 2. This was saying be on the lookout for a regime change because it went negative. Then it was just a matter of observing the phase transition into a risk-off period and acting on it. So the tools have been working pretty much as expected. The current setup is still unfavorable. So if you put the two together, we are currently in a risk-off Quad 3 regime. The 3 to 12 month outlook, which we take from this tool, is unfavorable. And from here, we would look to either the risk matrix changing to change our allocations. If this weather model changes where the stock market goes neutral or even goes green, that is going to tell us be on the lookout for regime change. And this includes more than just growth and inflation. So we have a couple of measures of employment, corporate profits, fiscal policy, positioning, sentiment, interest rates, credit, and liquidity. So any of those variables could change and indicate that growth and inflation could be expected to change. In terms of our positioning in all asset, what's notable is we had 55% equity exposure when we were in Quad 2. That's taken down to 18%. Commodities were 8 and they're down to 2. Bitcoin was 5 and they're down to 1. So this is a very defensive portfolio. And of the equity exposure we do have, it is mostly the defensive sectors like consumer staples, where we own, Costco and Procter & Gamble, utilities, the S&P Low Volatility Index, the S&P High Dividend Index. In the active fixed income positioning, this hasn't really changed during this phase transition. So we do have a large allocation to T-bills. For the most part, we've done well in this strategy by avoiding 10-year, 20-year, 30-year duration. We have a decent amount of inflation-protected bonds, TIPS. That served us well. In the traditional bond category, we have two different funds. One is actively managed. The other one is hedged. Those have both served us well. The high yield is basically the top 20% of the high yield index in terms of financial metrics. You know, it's an oxymoron, but the higher quality end of the junk bond market, then it's short, the lowest end. So because of that hedge, that's actually been a pretty good investment for us, despite, you know, being in a risk-off market. And then a lot of the outperformance has come from gold. We've owned gold in the all asset strategy. We have it in the bond portfolio. Getting over to systematic macro, we have it in systematic macro. This strategy is down from 60% to 0 in equities. Commodities and Bitcoin have also been reduced. In terms of policy uncertainty, I won't go through this in detail. If you want to hit the pause button and read it, you can. If you want to click on the link for a one-on-one, we can go through it in more detail. But, you know, we have major initiatives, you know, going on. We want to change 40 years of trade policy. We want to change 40 years of immigration policy. We want to change spending. Deficits are at an all-time record high, aside from World War II and a brief period around COVID. And we got to pay for that. So the Treasury is going to be issuing a boatload of debt. It's not clear to us that what's left to buy the debt are basically domestic private sector buyers. The Fed isn't buying, they're actually selling. Foreign central banks are not buying, commercial banks are not buying. And in an effort to get Germany, for example, to pay for more of their defense, it looks like they may do that. And if that's the case, they're going to have to issue a lot of sovereign debt. And it could be that Europeans decide to buy German sovereign debt instead of US Treasury debt. So the pool of potential buyers are basically domestic private sector buyers like us that buy because we want to, not because we have to, and who are price sensitive. So the real question is, at what yield will the Treasury have to pay in order to get enough buyers? And what would be a positive outcome for Treasury issuance is that the stock market continues to get worse. That would drive money out of equities into bonds for safety, and that would be a perfect time for the Treasury to term out, you know, all the debt that they need to. So the economic data we track does not include the impact of any of these policies to the extent that they get implemented and we can begin to see the size and the scope of it. You know, that will factor in. But notice on here, there's a sequence where it's usually the negative before the positive. And, you know, all of this is coming out of Washington, and let's face it, Washington is motivated by politics. And I think there is an incentive, not just for this administration, but every administration does it. Get the bad stuff out of the way first. You know, take the bitter pill now. And the idea would be you want 2026 looking good because that's a midterm election year. I wouldn't, you know, make an investment decision on the basis that, hey, there's a political incentive. We're making investment decisions based on what our signals are telling us to do. But that's still out there kind of in the back of my mind that, you know, the setup would be to kind of kitchen sink it now, clear the decks, and then set the stage for, what could be a strong recovery, because to the extent that these positives come through, there is a lot of upside. It's just that we have to go through some rough waters to get there. So, in summary, as it stands right now, the consensus is too high relative to our estimates on S&P sales growth, S&P earnings growth, and US GDP. The data that we get for these estimates are more reliable than the Bloomberg consensus. So we assume that the consensus is going to have to come our way. Consensus is too low on inflation. So if you put the two together, the consensus, and you have to assume that investor positioning is aligned with these consensus estimates. So if estimates for growth come down, estimates for inflation come up, growth down, inflation up is quad 3. And that implies to us that not as many investors are positioned for quad 3 yet as there will be. As I mentioned, policy uncertainty is at extreme levels. The range of probable outcomes could be anything from extremely positive to extremely negative. And there could be a sequence where the bad stuff hits before the good stuff hits. And it also calls into question, if we do get major immigration reform, major trade reform, major regulatory reform, it is going to reduce the reliability of historical data. We are going to be seeing data on a going forward basis that incorporates the impact of the policy changes, and we're going to be comparing it to historical data that doesn't. So we'll be aware of that, and we think the tools that we have between the risk matrix and the weather map will continue to serve us well. And it's going to be our job to follow one. Lastly, I wanted to draw everybody's attention to our market insights piece. This is a sample from March. Everybody should be receiving this. It comes out monthly, and in 1 or 2 paragraphs, can we provide a very succinct statement about the current state of things. And I'll highlight from the last issue, after a persistent battle between quad 2 reflation and quad 3 inflation, the current market regime has evolved into quad 4 deflation. That was the case beginning of March. This is not unexpected in that our 3 to 12 month asset class outlook for equities flipped negative 2 months ago. That is the weather map that flipped negative. That told us, be on the lookout for regime change. Next paragraph. Basically, we said that this is going to set up a market regime battle where quad 3 is likely to dethrone quad 4, and that did happen. In the asset class strength, this 3 to 12 month outlook on the right, that's taken directly from the weather map. And if you continue to the bottom of the page, here we have the systematic macro where changes were implemented right away. Some changes at beginning of March were implemented beginning of the month. The change there was a little bit more gradual based on the different signals that we use. And then we give a current snapshot of the market regime. Quad 4 was a dominant regime, but you can see how flat this is. That is a pretty wide distribution. And what's happened since then is quad 3's taken the lead, and the signal strength has gained. So I would just encourage you to pay attention to that, to the extent that, there are any changes that we're making, there are possible changes that we're contemplating. That monthly market insights piece would be a nice way to keep tabs on things. And obviously, if you have any questions about it, just call. So thanks for tuning in. I hope all of you click on the link to set up a one-on-one. And until next time, I hope everybody has a good day.